I'm very pleased to introduce Charles Rosati, who will be our keynote speaker today. Charles's bio is in our events page, so I'm only going to mention two things. One, between 1997 and 2002, he served as Commissioner of the Internal Revenue Service. He began at what was a very low point for the IRS and oversaw a major restructuring and did much to restore the agency's effectiveness and public reputation. In 2005, he served on President Bush's advisory panel on reform of the federal income tax, and it was really had some terrific ideas. It's unfortunate that the powers that be didn't give it more attention at the time. So today he will present some ideas on what we can do about the tax gap. So I'm very interested in hearing what you have to say.
Thanks, Eric. Thanks for the introduction. And first, let me mention three people who have worked with me on this project. Belinda Smith, who was my longtime trusted assistant, both in AMS and the IRS. Fred Foreman, who was my colleague for many years and technology leader at AMS, later came into the IRS as Associate Commissioner for Modernization. And finally, Mike Udell, well known to many of you in the tax community. He's now with the District Economics Group, but started as a revenue estimator with the Joint Committee. So today, as we hold this conference, we're in the worst crisis of my lifetime, a pandemic, an economic depression, and a social justice crisis all at once, and one in which the Federal Reserve is printing unlimited trillions for the government to spend. In that context, I think we could say it's a bit of an act of faith to have a conference on tax administration. It presumes that at some point the government will pivot back to wanting to actually collect taxes. And so I am glad you're doing it, because I agree with that, and I think that will happen. I just don't know when. But it is the reason why I wrote an article published with exquisitely bad timing on March 2nd called Recover $1.6 Trillion, Modernize Tax Compliance and Assistance. Although I was IRS Commissioner for 5 years, I'm actually an interloper in the tax world, having spent 45 of the last 55 years in private business. And in no way, shape, or form, do I consider myself a tax expert. And in the last 15 years, I have written or said nothing about taxes. I woke up about a year ago when I saw that there were many proposals being floated by various presidential candidates to raise or present new forms of taxes, perhaps necessary. But it made no sense to me, and still doesn't, that we would raise taxes on the people that are already paying, while there's large amounts of taxes that are simply on the books but are not being paid, which of course is what we know as the tax gap. The practical question is, what can you do about it? And that's why we went to work on this project. As you know, many of you know, the tax gap is a measure of how much of the tax that should be paid and is on the books to be paid, but is not paid. Well, how big is it? We could say numbers like $600 billion, but for many average person, big, huge numbers like that don't mean a lot. So let's look at two other ways to see how big the tax gap is. And if you could just bring up slide number 2, the tax gap slide, I'd appreciate it. Okay, so here's two comparisons of the tax gap, blue in the middle. One is it's actually larger than all the taxes paid collectively by 90% of individual taxpayers, 90% of individual taxpayers. It's about 87% the size of everything the government spends on all domestic programs, health, education, roads, bridges, law enforcement, all the rest. And of course, if you look on the little bar on the right, it's many times what the IRS budget is. So what has the government been doing about this large sum? You could say it has been doing nothing, but that actually wouldn't be right. It's better to say that it's been doing less than nothing. Bring up the next chart, please. Next chart, please. Okay, here's a trend over the last decade, and it just shows that the tax gap, of course, gets relentlessly bigger as the economy grows, but the has been actually shrinking because of its budget cuts. So tax gap bigger, IRS smaller. Bring up the next chart, please. If you look over even a longer period of time, what you find is that the IRS capacity has been steadily eroding year after year. Small cuts don't seem like much in any one year, but over a period of time, they accumulate to a really big drop. And this shows over 25 years, for example, that the capacity of the IRS has dropped about 30%, while its workload has increased about 30%. And that's just in numbers. If you were to think of complexity, it would be even greater, which you can get a hint of by looking at the number of corporate and partnership returns, which are up 80%. So you can take that chart down now. Thank you. This is why I have said, of course, that they haven't done anything to do about the tax gap, but I don't want that to be interpreted as meaning that I'm criticizing the IRS, because, of course, the IRS has been subject to these budget cuts from outside itself. And I personally believe that the IRS has done a rather good job with the limited resources and declining resources it has. So it's not the fault of the IRS. It's a result of short-sighted and I would say rather foolish decisions being made by administrations and Congresses over many years. That raises another question, which is, given the steady decline in enforcement, why has the tax gap not grown even faster? The IRS studies show that although it's growing in dollars, it's been relatively constant as a fraction of total taxes due. That seems like a bit of a contradiction, and maybe it is, but it actually can be resolved rather easily by 2 points. Most importantly, most taxpayers have no choice. Their income is in a form that's either withheld or reported in a way that is very easily checked by against third-party reports. Think of wages, salaries, interest, dividends, and maybe Social Security. But a second reason is that most taxpayers, even those who could more easily cheat, consistently say that it is not acceptable to pay less than you owe in taxes. So fortunately, many of them do. However, that still leaves a significant minority who have both the opportunity and the willingness to pay less than what they owe. And that's what they do. And that's what gives rise to the tax gap, which is why I say that the failure to do anything about this tax gap is actually quite unfair, since it's being created mostly by a minority of taxpayers, as well as being a huge financial loss. So my next question is, why is there such a complacent attitude about this matter? It's certainly a huge number. And I will say that if I talk about the tax gap, even in short form, to any of my friends in private business, which is where I've spent most of my life, and including in the last 15 years, invariably I will get a reaction of amazement that it's out there, that so little is being done about it. It's certainly not something that anyone in a business world would accept. But when I talk to people here in Washington that are more steeped in government, we get a very different reaction. And I found a statement in a column by columnist George Will last year that really captures what I think is the broad attitude in the Washington area, Washington government community about this tax gap. And I'm going to quote what he said. Quote, "Shrinking the tax gap is a decades-old aspiration in Washington that would have been accomplished already if it were possible." I think that is a widely accepted attitude among people in Washington that are involved in the government. Now, you could say that that attitude of indifference is, perhaps driven by cynicism or stupidity. You could say that, but as usual, when it comes to government matters, there's a big dose of complexity that's mixed in. It's just not that simple. And the reason I say that is that if you look at what the IRS collects from all the auditing it does, all the exams it does, the total amount is only about 2% of the tax gap. So anyone could see easily that if you simply doubled the amount of exams or triple the amount of exams, it still would not make a huge dent in the tax gap. Now, I don't think that's an argument against doing more traditional auditing, since the traditional auditing does more than pay for itself, and it may have some deterrent effect and probably could be better targeted. There was an article recently by former Treasury Secretary Summers and his colleague Natasha Sarin that wrote what I considered a good piece on how more traditional auditing could be better targeted and work better. And I think that would be a good thing to do if we don't do anything else. But if you really study it, it is true that if we want to recover a substantial fraction of the tax gap and really make progress, we need a new approach. We can't do it simply by scaling up traditional auditing. So that's what we have been working on. And I think we can accomplish this goal by doing two main things. One is fill in the holes in the sources of income that are reported by third parties to the IRS. But secondly, make much more effective use of technology to use all the information that the IRS has to identify and follow up on underreporting and deficiencies. The technology component really is critical because even today, the IRS cannot make use of all of the information it already has. GAO reported, for example, that only about 15% of the cases in which the IRS identifies a specific mismatch were able to be followed up on. And there's whole categories of data, such as, for example, about 40 million K1s reporting partnership income that cannot be matched at all. They can be used in an individual audit, but can't be matched in an automated sense. So these are the two principles which we'll discuss in a little bit more detail. But first, let me bring up a chart which shows our estimate of what this approach could be over a 10-year period. You can see the numbers. It accumulates to a big number over 10 years, over 1.6 trillion, the title of my article. And yes, it's a big number, but I'll mention a couple of things. One is it builds up slowly because we tried to be conservative or at least realistic on how fast the IRS could implement the proposals that we're making. And I should say that these estimates were not just top-down numbers. They've all been based on specific calculations of what we think our actions would produce, and they're all laid out in great detail on our website if you want to study them. But let me just mention two other things. One is look at the top row. You'll see that if nothing more is done than is currently being done, we follow the present course, this tax gap is going to grow massively. It's already at 600 billion. It's going to approach $1 trillion, just growing relentlessly. But secondly, note that with our proposals, while we think they would generate a substantial improvement, even after 10 years, it would only recover about 29% of the tax gap at that time. So if you step back at this and ask yourself this question, does collecting 29% of the money that we as citizens are owed from people who are not paying, after 10 years of concerted effort, does that seem like an impossible, overwhelming challenge for the United States of America? I sure don't think so based on my experience. And I would compare it to many other projects that our country has done, our government has done, or even the IRS has done, that I don't think are more difficult than that. So yes, I think it can be done. Where would the money come from? Could you bring up the next chart, please? All of you probably in the tax world are familiar. This chart comes right out of the last IRS compliance study. And what it shows, of course, is that the greatest portion of the tax gap comes from income that is not as visible or is not visible, has no visibility to the IRS from third-party reporting. The columns on the right are the incomes such as sole proprietor income, the rents, which has this minimal visibility. And there it shows that 55% of the income that should be reported is not, more than half not reported. If you go to a middle category, such as things as partnership income and some other categories, 17% is not reported. But of course, on the income which is fully reported or easily matched, it's almost all reported. So by filling in the holes in what is in reporting, but also using the technology to assess and follow up on this, our proposal is to move much of the income that's in the lower visibility categories up into higher visibility categories. And why shouldn't we do that? Why shouldn't that happen? Why should a wage earner, report and pay tax on all their income while someone else pays tax on half just because it's not reported to the IRS? I mean, that's what this current situation boils down to. So that's the essence of our proposal. Move most of the low visibility income to a higher visibility category. And if you think about it, that's the entire principle that makes it possible for the IRS today to collect trillions of dollars at a total cost that's less than 40 cents per $100. People pay and the IRS collects what's highly visible. Now, it's true that the income that's currently less visible is more complex to track, and that's where the technology comes in. It will make the visibility of business income closer to that of other forms of income. Next slide, please. It's not only business income of individuals such as sole proprietors on tax returns that is not reported and not paid. There are vast amounts of income that are generated in businesses organized as pass-throughs, partnerships, and S corporations. As what this chart shows is that 30 years ago or so, actually 35 now, most of the income, business income in significant size businesses was paid, reported and paid by corporations, C corporations, of course, pay the tax directly. Today, only about half is in C corporations. Almost an equal amount is in pass-throughs. And of course, those pass-throughs cover a wide range of territory from tiny ones that are almost like sole proprietorships to very large global businesses. In our study, we estimated that about 45% of that pass-through income is generated by what we would consider large businesses. We took those at $25 million or more gross receipts. Now, those large businesses generally do not contribute to the tax gap because what they do is generally technically compliant with the tax law. And of course, the tax gap only considers income that is lost that is not technically compliant. So therefore, in our study, we did not propose anything related or did not include any estimates of gains from these large pass-throughs, which is about half of it. I will say, as an aside, that doesn't mean that I do not think there are very substantial and important compliance issues, or at least reporting issues, with these large pass-throughs, and in fact, all large businesses, including corporations. It's just they're not part of the tax gap, and that's what the subject of this is. And if somebody wants to ask me about my opinion about these larger businesses, I'll maybe make some comments otherwise, but it's not part of this study. So you can take the chart down now. So let me talk about what we did suggest with respect to these pass-throughs. There are about 7.5 million of them that generate about 7 trillion of gross receipts and about 800 billion of reported income. That's a lot of money, and that exists in a tax limbo because number one, there's no third-party reporting of their income, at the business level, nor is there much of any IRS examination activity to check it. It's essentially negligible for these pass-throughs. So I would refer to that as a sort of a enforcement-free zone. An IRS study that studied one part of the universe of these pass-throughs and looked at the underreporting level found that for many of them, the underreporting level was comparable to that of sole proprietorships. For those that were in a somewhat larger end of the spectrum, the compliance was better, but still significant underreporting. So in our proposal, we included a similar proposal for these category of pass-through businesses that would require them to have third-party reporting and also use technology to follow up on them. Now, let me shift a little bit to explain, a little bit more about how our proposal would work with the two main elements, more reporting and more use of technology. With respect to the reporting, we propose what amounts to a new 1099 form so that taxpayers with business income over $25,000 would designate to their bank what accounts they deposit their business income. And that bank would then report to the IRS on a 1099 style form the total deposits and withdrawals annually on those accounts. In addition, we would require the taxpayer to attach a schedule or reconciliation schedule to their return that reconciles the amounts on their return to the amounts reported by the bank. I would note that by adopting a $25,000 threshold for this reporting, we would exempt 70% of individual taxpayers, but only about 14% of their income. So then what would the IRS do? The IRS would assess every return using all of this information, the new information, as well as all available information from third parties to identify and specify likely areas of underreporting. And this technology would have two key elements. One, it would be technology that can very easily and rapidly process very large volumes of data. And to just give an example, when I was at the IRS 20 some odd years ago, the taxpayer database, that full taxpayer file, was considered a giant file. We had all kinds of issues about how fast we could process it. If you look at the technology today, processing that entire taxpayer database would be like eating a single hors d'oeuvre on an all-you-can-eat buffet. It amounts to nothing in terms of data today. So there's plenty of capacity to process everything. But secondly, the kind of models that would be used would be the new kind of what are called machine learning models. The IRS has always used models. In fact, in the past, it's been a pioneer in using models. But the newer models can not only use all the data that's available, not only on the return, but all the external data, but can learn from its as it goes to identify more and more specificity the issues on those returns. You can think about it as sort of an unlimited supply of our best revenue agents who, if they had access to all pertinent data on a given return, would analyze all of that and identify what the issues are with that return. That's essentially what the technology would do. The follow-up, once issues were identified, would be done in a way that is somewhat similar to the way it's done today, but with far more technology support. We identify three kinds of follow-up. One is specific line item matching, where there's a particular line item that's clearly mismatched. Secondly, what we call e-exams, which is our word for what's now called correspondence exams, because they would be done with much more electronic communication and support. And thirdly, of course, the more traditional field exams. I would note that a lot of the time that is currently spent by employees and taxpayers in any kind of an examination process is spent gathering, analyzing documents and information. A lot of that can be eliminated, or at least, not eliminated, but be done by the technology, leaving the people part and the communication part to work with resolving issues that are identified. The improved technology would also make the taxpayer experience more efficient and faster by not only providing more specific data to taxpayers, more specific notices and communications, but also using secure electronic communications to resolve issues more quickly. Now, the IRS is already using all of these technologies, at least on a limited scale. And I would identify one program in particular that is a great example, called the IRS Return Review Program, which uses these kinds of technologies to identify identity fraud and overclaims of refundable credits in refund returns. This program has been very successful, as has been verified by, of all people, the General Accountability Office, GAO, which wrote a report indicating that this was a model program that should be used as a model for other kinds of compliance programs. And the GAO report identified that at the time they did the report, it had produced $6.5 billion of revenue savings at a cost of $415 million, which is a 15-to-1 ratio. So we view this program very much as a model and a forerunner for what we're proposing. Fred and I are in the process of writing a second article that will go into more detail about how our proposed modernized processes and technology would be implemented, and also making a better, more reliable cost estimate. And I will say, we're not saying that this would be cheap to do. Roughly, for looking at what we're going to come up with in our article, we think it would cost about $50 billion for the technology as well as increased IRS enforcement staffing, $50 billion over 10 years. That equates to roughly about a 6% a year over and above inflation, 6% a year for 10 years, which is a rate of increase that I think is well manageable. But the payoff, of course, would be many times that, just as it has been for the return review program. So what would it take to succeed in this kind of a program? Granted, it's a broad program. We think there are 4 things that would have to be required for it to succeed. Number one, we believe it would have to have authorization set in law by Congress in a manner that it was somewhat similar to what Congress did in 1998 with the Restructuring and Reform Act, which provided a lot of mandates, including to the IRS to convert to electronic filing, something that's been successful. So it would have high level but clear goals. I want to say that we would not recommend that the IRS or even an administration take on this kind of a program without specific authorization set in law by Congress. Secondly, within the IRS, it would require a dedicated and high-level management program, similar to what the IRS did when it implemented in the first 3 years of the Affordable Care Act. It's part of the Affordable Care Act. I would say that having looked at what the IRS did there, that is a more complicated program by far than anything we are proposing, and it was done. Thirdly, consistent, adequate funding. Consistency is as important as adequacy. Off and on funding will kill everything. And finally, you do need constructive oversight, but it needs to be constructive, meaning forward-looking and aimed at finding not only problems, but also solutions that would help move the program towards its goals. That's our summary, and I'll be glad to take questions.
Okay, Charles. I think I'll start if that's okay, and then
Sure.
we have a few others. The IRS has kind of a mixed record with technology programs. You mentioned the success in your paper of electronic filing, but then there are also these efforts to develop a new customer account data engine, and we end up still having the 1960s master file system after all these efforts. So I guess the question is, what characterizes some of these successful versus unsuccessful efforts, and what structural changes might the IRS need to implement so that the modernization efforts you recommend will be successful?
Well, it's a great question, and you pointed to 2 points. One is what characterizes the more successful versus less successful, and the structural changes, and they're both on point. So the IRS experience in this respect is not that different from many other organizations. The taxpayer data file that you mentioned, the customer data engine and the basic tax processing system is a legacy system that has 50 years of accumulated, basically, tax code changes built into it. It's a system that has to be updated every year and has to stay in business to keep the IRS in business. Replacing a system like that of record is a very difficult job in any business. And replacing legacy systems like that is always going to be slow and difficult. Not to say that the IRS couldn't have been done better, but it has made progress. And I think over time that particular project needs to be replaced, but it could never be done. Replacing a legacy system like that is never fast and never without a lot of risk. On the other hand, and this is true in many organizations, including the IRS, a new system that has as little relationship as possible to these embedded older systems, which we call legacy systems, is a much more practical and more reliable thing to do. And I'll give you 2 examples in the IRS. I mentioned one, which was the electronic filing. When I was at the IRS, we really were just getting started electronic, but there was really some pilot projects, almost nothing. And, we had the goal to do it. And over a period of time, we did, the IRS did, not just when I was there, through any commissioners. That was a really big change. At the time we were doing it, there were many people who really thought that for many, many reasons, including security issues and other issues, it could never really be done on a large scale. We had political issues with the software industry and other things, but eventually it was done. But it was done in a separate way from the old systems. I mean, the papers processing continued, the new system came into effect, and there was a relationship between the two, but it was as narrow as possible. And eventually the paper processing phased down when the new one came up. It wasn't a big bang cutover all at once. Another example, which I mentioned briefly, was the Affordable Care Act. The IRS was given a role, not the website, which was done by a different agency, but the IRS had a very, very significant role, a very difficult implementation, which had 47 different provisions to implement in a relatively short period of time, starting in 2010. And it actually did those successfully. It was indicated by GAO again that that was done successfully. So it was very complicated. It was very difficult. It actually was more complicated than what we're proposing because it involved a lot of interaction with other agencies, but it wasn't very much dependent on replacing, your basic tax processing system that had to process returns every year. So that's the key point, having a new system that can be built in parallel without having to tear down the old ones. That's one. The other is what you said is how do you manage it structurally? And again, I use the Affordable Care Act. They did have a program office that was managed at a very high level, which is what we need. And in our paper, in the second paper that we're writing, we're going to go into great detail on both of these points. But it basically boils down to having a dedicated, long-term, high-level program office that manages that program on a dedicated, consistent basis, with high-level support to make decisions rapidly so you aren't bogged down. Those are the two requirements.
Okay, thank you. I have a question from Brian Arard. He mentions that new information reporting for businesses seems promising, but you mentioned that non-compliance tends to be concentrated in smaller businesses. So the question is, even with improved selection, you would need to audit a substantial amount of businesses face-to-face or via correspondence. And do you think there is an appetite within Congress to provide more audit funding for that?
Well, I mean, first of all, it's not a one-for-one auditing because the technology can identify much. And by the way, when we say smaller businesses, we would exempt, at a $25,000 threshold, which is what we proposed, we deliberately did that to see where the balance would be. That exempts 75% of individual businesses, 70% of individual businesses. So, it's not really the tiny businesses that you're talking about. It's substantial size businesses. And especially when you get into the pass-throughs, we're not going for the giant pass-throughs with 25 million and 50 million, but over 25,000 up to 25 million is still a very substantial size businesses. But with respect to what Congress would authorize, I don't know what Congress would authorize. I don't know. What I do know is that if you went to you would have to go and get authorization. That's why I don't think the IRS could do it on its own and lay out what it would be required. And yes, it would require some increase in staffing for enforcement as well as technology. But if you weigh that against what is at stake, which is, an ever increasing tax gap starting at $600 billion when the government is looking at all kinds of schemes, I'll call them, or plans, let's call them that, to raise revenue, that's a decision that would have to be made. I think that the question, though, is would Congress agree to it? I don't know. I think they would have to agree to it in advance, in effect, by saying we want to do this program, and that's one of the ways we're going to fill the gap in the revenue we need. But it wouldn't be tiny businesses. I'll say that. We're not talking about, people that, get $10,000 or $20,000 from a small job. It's substantial size businesses.
Okay, I have a question from Thomas Hertz. He's asking, what about the overstatement of business expenses for sole props, S corps, et cetera? Isn't that a pretty important avenue?
Yes, and that would be covered. It's not just the revenue side. What we're saying is that the technology is going to look at the income. That includes both deductions and revenue.
Okay.
And we believe that because the reporting the bank reporting that we're proposing would be both withdrawals and deposits, and the reconciliation schedule would require the taxpayer to reconcile their expenses as well as their revenues.
There's a question from George Gutman, who says the reason we have such a high level of compliance on wages is also withholding. Even with more information reporting, you cite a GAO report that says only 15% of mismatches are followed up. Mm-hmm. And he asks, would it not be more efficient to have more withholding at source?
Well, it might be, but even if you look at the income that is reported but not withheld, there's still about 95% compliance.
Mm-hmm. Yeah. I guess I'm running out of, there's a question about whether there's a political will to target the SBSE base of voters, the small businesses. I think you may have addressed that, but.
Well, we're not targeting anybody. We're just saying that everybody should, we don't know why it would be reasonable for, people to pay income only on half of what they report just because it's not reported by a third party. I don't think we're targeting anybody. What we're doing is trying to equalize and make it fair across the board. It's not every small business or every business is underreporting. Most of those businesses are also paying, which is the real irony of it. I'll tell you a story if I have one more minute, because I think it's an interesting story. From my IRS. I don't tell war stories, but here's one anyway. Okay, so when I was in the IRS, I got a visit from lots of different taxpayer associations groups. One of them comes in, actually was more than one, and I'm not going to say what it was, but it was a group that represented a certain industry, and they came in and said that their problem was that they were, an association of people that were paying their taxes in this business and reporting correctly, and they were getting killed competitively because there were too many people in competitors in their business that were doing things off the books and were not paying taxes. And wasn't there anything we could do to increase our enforcement so that they wouldn't be at a competitive disadvantage? And of course, we would have loved to do that, but that was just impossible because there was no way with the resources we had and without any technology to do that. So, this is the irony. It's true everywhere. The majority of businesses that are, even whether they're small proprietors or whether they're partnerships, are reporting and paying. And they're being disadvantaged by the minority that's paying less. So, it's not targeting small business in any way, shape, or form.
Okay, I have a question from Natasha Sarin. And Natasha asks, are there actions the IRS conceivably could take absent congressional action? And when you say authorization, will it be enough just to increase budgetary outlays?
I don't believe it would be enough to increase budget. Well, there's two questions there. What I'm recommending, if I look back at the Restructuring and Reform Act, for example, it was not a budgetary action. It was actually a tax law, change, which I think is very important. I think it's important that if you want to do this, that you have, adequate consideration, and there would be requirements, in the law, for example, for additional reporting, but that it be set out as a decision of Congress to authorize and set forth some high-level objectives for the IRS to improve the level of compliance and reporting and reduce the tax gap. So I think it's not just budgetary, it's authorization. As far as what the IRS could do, well, I think when I was at the IRS, and I think this is true now, I always said, that we need to do the best we can with the resources we have. Okay, that's what you can do. And so there's always ways. I know that Natasha's article that she wrote indicated some, I think, very good ideas about how auditing could be better targeted. And I think those are very worthy ideas. So, we don't have to wait, and I wouldn't recommend waiting until you get the big authorization. You do what you can. But my only point is, regrettably, without a bigger program and a longer term program, the progress is going to be at best relatively incremental. It's not going to make a big dent.
Okay, well, I think I've run out of questions. I guess I have one I can indulge you with. Sure. One more. The IRS has a relatively old workforce, and I guess it's something I've always been concerned. How does the IRS go about rebuilding its workforce? And does it need to, for example, recruit senior personnel from the private sector as it did in your era?
Another great question. See, this is another thing that you're right. First of all, I'm not that you're right, but I am not just an optimist by nature, but by practical experience. I am very convinced that if the IRS, and this is why authorization from Congress is very important, if the IRS was given a job, a mission, such as I suggest, and reasonable funding, I believe that you would have no trouble whatsoever recruiting people at all levels. And yes, you would have to recruit some senior people in, and you could do that. The IRS from time to time has had authorization to recruit mid-level and upper-level people, both for management roles and technical roles, but also people at all levels. The people will respond to the mission. We did have that opportunity for about an 18-month period, only a small period when I was the commissioner, after nobody had been recruited as revenue agents or anybody for years. And it was during the boom period of technology. And, you know, we got a tremendous response, but we did it because people actually will respond to a mission. By the way, this is true in the private sector. You know, people will flock to something that has a clear mission and something that's worthwhile to do, as long as they're reasonably compensated. They don't have to be paid, you know, top dollar, but as long as they can feed the family and make a reasonable family. If you can set forth the mission, they'll respond at all levels.
Okay, well, I think we've come to the end of this part of the program. Thank you very much, Charles, and we certainly, you gave us a lot to think about.
Thank you.
I'm going to now turn this over to Fran Capoletti, who will go right to the next session. Thanks again.
Okay.